The heaviest zero-DTE volume doesn't happen on quiet, boring trading days. It happens on days with scheduled economic data releases. Consumer price index reports, jobs numbers, Federal Reserve announcements. These are the days when implied volatility is already elevated, when market makers are already nervous, and when the potential for sharp intraday moves is highest. Retail traders are piling into same-day options right when the market is most likely to gap or spike. If you're holding zero-DTE calls and the CPI comes in hotter than expected, the market can drop 1% in 10 minutes. There's no time to adjust. There's no opportunity to roll the position to next week and give your thesis more time. You're just watching the value evaporate in real time as the countdown to expiration continues. This is also when liquidity gets worse. Market makers widen spreads during high volatility. The bid-ask spread on a zero-DTE option that might be 10 cents wide in normal conditions can blow out to 50 cents or $1 when data hits and the market moves violently. The real question is what happens when this structure gets stress tested. We haven't had a true volatility event since zero-DTE volume reached these levels. The boom in same-day options happened during a period of relatively calm markets. The VIX, which measures expected volatility, spent most of 2023 and early 2024 below 15. That's low by historical standards. We've had brief spikes, a few days here and there where the VIX touched 20 or 25, but nothing sustained. No multi-week period of panic. No credit event. No geopolitical shock that keeps markets in risk-off mode for an extended period. What happens if we get a real drawdown while $1 trillion in same-day notional exposure is sloshing around the market? Let's walk through the scenario because this is where individual losses could potentially translate into broader market instability. Imagine a surprise event hits overnight, a geopolitical crisis. A major bank announces unexpected losses. A central bank makes a policy error. The market opens down 2% and continues falling. By mid-morning, the S&P 500 is down 3%. Volatility spikes. The VIX jumps from 14 to 35 in a matter of hours. Hundreds of thousands of retail traders are holding zero-DTE call options that are now deeply out of the money with only hours until expiration. These positions are effectively worthless, but many traders are also holding them on margin or have used leverage elsewhere in their accounts. As the market falls, brokers start issuing margin calls. Accounts that were margined appropriately when the market was stable are now under-collateralized. Traders have minutes to deposit more cash, or the broker will liquidate positions automatically. Most retail traders can't meet a margin call in real time. They're at work. They're not watching the market every second. They don't have additional capital sitting in a bank account ready to transfer. The broker's risk management system doesn't wait. It starts selling. Stocks get liquidated to bring the account back into compliance. This selling happens into a market that's already falling, which pushes prices lower, which triggers more margin calls at other brokers, which creates more forced selling. At the same time, market makers who sold all those zero-DTE calls are now sitting on enormous short gamma positions. Gamma measures how much a market maker's delta exposure changes as the underlying market moves. When you're short gamma and the market moves against you, your hedging requirements accelerate. As the market falls, market makers who are short calls have to sell more futures or stock to stay hedged. $1 trillion in notional exposure might sound abstract until you realize that the actual capital supporting that exposure is a tiny fraction of the notional. If the average zero-DTE position is leveraged 20 to 1 or 50 to 1, it doesn't take much of a market move to wipe out the equity behind it. Now, let's be fair and consider the counter-arguments, because there are smart people who think this concern is overblown. First, the notional exposure is huge, but the actual premium at risk is much smaller. If a retail trader buys $1,000 worth of zero-DTE options, that might represent $100,000 in notional exposure, but the trader can only lose the $1,000 in premium. The losses are painful for the individuals involved, but they're not necessarily systemically destabilizing. A few $billion in retail options losses spread across millions of accounts is not the same as a bank failing or a credit market seizing up. Second, market makers are sophisticated. These are not amateurs. They have been managing options flow for decades. The risk management models at firms like Citadel Securities and Susquehanna account for gamma exposure, pin risk, and expiration dynamics. They stress test their books. They have capital reserves. It's entirely possible that the big dealers have run the scenarios and determined that they can handle a volatility spike without breaking. They might even be positioned to profit from it, since they're generally selling volatility to retail traders who are buying it. Third, retail options losses are not a new phenomenon. Retail traders have been losing money on options for as long as options have existed. Studies from the 1990s and 2000s showed that the majority of retail options traders lost money over time. The 80% loss rate on zero-DTE options is brutal, but it's not that different from the historical loss rate on short-dated, out-of-the-money options in general. This might just be the latest iteration of an old pattern. The product has changed, but the outcome hasn't. Fourth, the market has a way of self-correcting. If enough traders blow up their accounts, zero-DTE volume will decline on its own. The fad will fade. We saw this with day trading stocks after the dot-com crash. Millions of people tried to day trade in 1999 and 2000. Most of them lost money. By 2002, day trading volume had collapsed because the people who were doing it had either run out of capital or learned an expensive lesson. The same thing could happen here. The market teaches and the tuition is brutal, but the lesson eventually sinks in. If your goal is to build wealth over time, to fund retirement, to achieve financial independence, zero-DTE options are not a tool that belongs in your process. They are a distraction at best and a catastrophic risk at worst.